real estate market imploding? If you're a buyer, are you thinking, should I be buying? Should I be waiting? Should I just wait until things completely change? If you're a seller thinking about leaving the area, is this the right time to do so? This week, because incredibly enough, we are already in early October. October is here already, which means Halloween's around the corner, Thanksgiving's around the corner, Christmas is around the corner. It's pretty crazy how quickly the year has gone by. But because it's the 1st of October, we will be going over the market updates. And so we will be able to see what exactly is actually happening in terms of the Bay Area real estate market. Are things going as poorly as people may think? We will see. And we're going to be looking at several different stats today. We're going to go heavy into the stats. That's what I always do in the first weekend of each month, because the entire of last month is all gone. So if you're thinking of buying, selling, or investing, or if you have any friends that are doing it, you got to share this with them, because this is all very real time. This is not all old articles that people look at July figures and say the world is ending from there, because as you can see for yourself very clearly, where is the market going and what is actually happening. So there are a few leading indicators actually to, if you're trying to predict, which is a very hard thing to do, but if you're trying to time or predict where the market will go or how have things progressed, then you definitely want to see this stat. And so first and foremost, the key is, what does inventory levels look like? We're going to be looking at Santa Clara County, but to be fair, most counties in the Bay Area are doing the same exact thing. So there's not too extreme for any of these. Nevertheless, let's look at Santa Clara County, single family homes, condos, and townhomes, right? As you can see, here is the months of inventory. What does months of inventory mean? This is a really good indicator because this talks about the velocity of homes. How quickly will the existing home, so if there's no buyers on the market, based off of previous velocity, how quickly will all of those homes deplete? So it all deplete in 1.5 months if there's no new sellers. And so it gives you an idea of a velocity, how many people are transacting, but also relative to how many new listings are coming on the market. And we're going to look at those numbers too, because those are the things that happen in these higher interest rates environments of the shift of things. Now, as you can see, months of inventory, there were some times in July, this was actually the worst of times. As you can see, that was 2.1 months. Now, to be fair, this is still much lower than most places in the country, but it's still a lot relative to here in the Bay Area. And you can see in August, it had already declined back to 1.6 months. In September, it was actually even more improved at 1.5 months. So you can see there's plenty of people buying and doing transactions. But the question is, there's a lot of buyers again. There's more buyers than before, but it's also because there's a lot less new listings, because a seller with these higher rates, they also have to decide, why do I want to sell? Is that need big enough for me to want to sell, given my rate is at the 3s or 2s, right? Like, you got to remember, their cost base is also very low. They're not paying current rates. Anyone that bought a home in the last year is probably in the 2s or 3s, because they could have also refinanced. Something to be very, very mindful of in terms of just how the psychology of it works. So that's months of inventory. So the other thing that I like to look at is, how many price reductions has there been? Let me see this one. I don't think this one will show price reduction here, but we'll go over that in a bit. Actually, there's a few ways to do that. We can see original price, sales to price ratio. This is a good number, because this actually shows how many reductions there has been. Because what sales price to original price ratio means is, it's not the sales price to the new adjusted price. It's the sales price to what they originally had it listed on the market for. And so as you can see, historically for a long time, typically homes were selling for above the original price. You can see it was actually that way all the way to June. Even June was 105% to original price. But as the months went on, you can see July was not good. It was at 100%. August was not good. It was the worst. It has been 97.2%. But you can see September has already picked back up at 97.7%. And so what does this also mean? It also means that the seller expectations has adjusted. So it means the seller expectations has already understood, okay, yeah, the market is not the same as it was before. We're going to be realistic because we want to make our moves. We want to move somewhere else. We want to just get a bigger home. We're going to be realistic with the market. And fortunately, people have been more realistic. So you can see that has changed. The other metric I want to share with you is number of new listings, right? This is what I talked about. Because rates are higher, how does the new listings count look? You can see August, not a lot of homes, 1,300 homes. If you want to compare against the busy seasons, over 2,000 homes, right? So that's a 700, so that's 35% less new listings come on the market. So that's something very important to understand, right? In this, there's seasonalities we were comparing to the hottest time of the year, which is usually the springtime. That's normal. So there's nothing unusual there. But also in general, we're going to have probably a lot less than before for this reason, given what I just shared of the uncertainty for sellers, but also the opportunity cost for making that move. The next thing I want to share with you is activity. This is a very good indicator of how things are going. So this is contingent pending, the number of contingent pending. So August had a big pickup when it comes to how many got in contract in the month of August. September has actually declined. So the amount of homes getting in contract is lower. So that is a concern. Now the question though is it lower because the number of new listings on the market is now a lot less? That has some aspects of it, or are there more buyers falling out? As in they're not looking anymore. That certainly has something to do with it. So those are certain things to be mindful of. Let's take a look at the number of active homes. So how many homes are actually on the market? So you can see the number of active homes has decreased. This goes back to those things that you brought up or that I've shared earlier of the inventory levels, right? So previously in June, July, which is the peak time and really the worst of time that we've seen this year, when there's a lot of homes on the market that are actively on the market because a lot of buyers were either out on vacation or they just gave up of looking. So you can see during those times there was 2,093 homes. And now, well, we don't need to look at October yet, it's too early. September, 1,694. That is a decrease of 20% of active homes that one can choose from. And so I have a few notes and thoughts about this, but let's look at the last thing, sales price, median price. This is actually a laggard. So this is a laggard because think about this, any homes that have transacted in September means that it's got in contract in August, right? But nevertheless, my prediction was very accurate. I said September numbers would likely stop bleeding. I did not actually expect it to actually have a tick up of price and actually increase. I thought it would have stopped bleeding because of, as I mentioned before, all those reasons. During that time, interest rates got improved. During that time, people came back from vacation. During that time, seasonality was returning back. There is seasonality in the Bay Area. There's so many people that went on vacation that had a different mindset. I don't want to buy a house right now. I'm traveling. I'm busy. I got to visit family. Lots of my clients are going back to like India, visit family there because they haven't seen them in a long time. There's just so much stuff that happened this summer. But as you can see, it did rebound. Now, moving forward, we'll see. But for anything like super drastic, I'd be mindful. We already had a pretty drastic turn of events already. So don't think that nothing has changed, right? We went from 1.61, which was in April, the highest point, to about 1.41, right? That's a $200,000 decline. That is equivalent to about 13-14%. But it's, as you can see, it's not continuing to go down at the same rapid pace. A lot of those moves have already taken place. So something just to be mindful of. This is the data itself. This is real time. All the other stuff that you may read on the headline articles are all always using old ones. Why? Because they don't even, most MLSs, which is crazy, in the country don't actually have real-time data, which is bizarre. If you actually look at Redfin data, you look at these other platforms, they're at least 1 to 3 weeks old, which is just crazy. But fortunately, you guys are all educated. You guys all understand this. You all see what is actually happening when it comes to the market locally. And so that's why you guys all have a competitive advantage. And of course, if you guys have any questions about your scenario, we can talk about it. As you can see, there are several things I want to bring up because of this data. Number one, you got to figure out what is the right decision for yourself. And how do you determine that? Do you plan to be in the area for a couple of years? If you plan to be in an area, whether it's Bay Area, whether it's Seattle, whether it's Austin, whether it's New York, whatever it may be, it probably makes sense to buy a home. And why is that? Even if the market declines, what do we think may happen? We are probably expecting interest rates to probably continue to increase. So you got to also remember this. Just because prices decline, how likely are you to time a price bottom along with an interest rate bottom? Right? You're not buying, most people are not buying all cash. Most people are using a loan. And so how likely is one to time it on both well, right? You didn't time it well when interest rates were low 2 years ago, and now you're wondering for yourself, has the boat sailed, right? So the likelihood of timing is very, very difficult, if not impossible. Just because prices decline doesn't mean the interest rate you had was the same as what it was before, or even better. And so because of the market timing is all about determining, okay, well, do you want exposure to real estate? How has your stocks been doing? Real estate has actually still done better, right? So if you look at the numbers, you say, look, it probably would have been a much better idea to have some vested interest in some real estate. And you can think about your own portfolio. So many of you listening have so much money in stock. I know many of you have millions of dollars in one company stock. And you see what happened with big tech over the last few weeks of how they're doing too, right? So the question is that the right move? Should you be divesting some of that into real estate? Do you have enough exposure to real estate? And so that's the decision making that people need to have of, okay, maybe I should get some more exposure to it. I'm outgrew my space. I have kids now. I just need more space. I'm tired of living in the same kind of cramped quarters that I have. So those are discussion points that you want to have internally, whether this is the right move for yourself or not. The other thing that's very important is this, and I tell people this all the time. Now, if you're okay mentally, say, look, I'm good. Like whatever happens with real estate, we'll deal with it accordingly, but the move is there. Once the move is there, you also have to look at this, right? It's not like there's a ton of homes that are coming on the market now. So real estate is, even though there's medium prices, you also have to be very realistic in terms of which areas you are looking at, right? Because at the end of the day, this is not like a stock market. It's not like you can't just buy and sell like Google stock, which you can do in milliseconds. Just because average homes in an area come down, you still got to find the home that you like. Does that make sense? Right? It's not like you're not going to buy any home out there. You still have to buy a home that you like in an area that is suitable within your range. And those are the important lessons and tips that I give for everyone, which is a very difficult thing to absorb because people say, look, the market is down. I can buy everywhere. No, if your budget is also down and the market is down, I mean, you're looking the same exact places that you're looking months ago, right? Unless your budget can be the same, which many of you can be the same, then you can look in those other areas that you weren't able to look at before, right? So very, very important to understand that, because if you do the math, the April figures and now, even though the prices were higher then, from a monthly payment perspective, they're going to be roughly similar. So your affordability is actually still roughly the same. And that's why I'm saying, like, even though prices have dropped, it doesn't necessarily mean drastically good or bad. Thank you for watching this short on my YouTube channel. For more shorts, go ahead and click here. For more live streams, you can go ahead and click here. I'll see you in the next one.